I see this all the time with business owners. They treat their company bank account like a personal ATM. Big mistake. The ATO sees random withdrawals as income, which means you'll get taxed once at the company level, then again at your personal rate. At my accounting firm, Box Advisory Services, we make sure our clients have a clear strategy when withdrawing money from their businesses. So today, I'm sharing a coaching session I had with my clients, where I'll go through 3 main methods of legally drawing money from your company, hybrid methods optimized for tax savings, real-world case studies, and common mistakes to avoid. Let's get into it. So there are, let me just quickly share my screen, multiple ways to take that money out. And most of the time, if you are working with me, you have a company. You're not operating through a trust. A lot of businesses, I recommend operating through a company. And the reason being is because a company has a 25% tax bracket, whereas a trust is something like this. And when you trade out of it, a trust is not a separate legal entity. It can't hold any profits. It has to pass the profits over to somewhere. And when the profits get passed to an individual, the tax rate could be up to 47%. And that's why we're not the biggest fan most of the time having a trust. We usually have a trading company as the business. It's better because it has a 25% tax bracket. You can leave profits in here, get taxed at 25, or you can pay the profits out to the individual and you can get taxed anywhere between 0 to 47%, depending on how much profits you make. So for normal startup businesses, they like to have a company. And the reason being is because you can get businesses or investors to invest into the business. And then you can have multiple individuals that own part of the business as well. So you don't just have one person owning it only. And that's a really good selling point for a trading company. Whereas a trust, it's usually a family trust and you can't do that. It's very hard to have another person own part of the business when it's a trust. That's why trust is only useful for family groups and big family groups where you distribute the profits between all the individuals. But that's another thing to talk about for another day. What we're talking about is mainly companies, and most of you guys have companies. All right, the 3 main ways is wages, dividends, and loans. The reason why you want to set up a company is because it's a separate legal entity, meaning that it gets taxed separately. It also has a very great tax bracket. So the tax bracket it has is 25%. Sometimes 30%, depending if that this trading company is a business or not. If it's a business and it earns income from like activities, not passive income, then it will be taxed at 25%. If it's earning income only on passive income, so you're talking about like dividends, interest income, share investments, or property rent, then it's considered like a base company, and a base company gets taxed at 30%. So basically your tax rate is anywhere between 25 to 30%, whereas the individual is 0 to 47%. So what we do as accountants and as business owners is we play with these 3 to work out what the best scenario is for you. And things that I see a lot of directors and business owners make mistakes on is that they don't actually legally put in wages properly. So they just take money out of the company thinking it's wages. But when it comes to wages, you actually need to deal with superannuation. You need to deal with wages tax, which is also called PAYG withholding. They need to register for the taxes, and they don't do that. They don't do pay slips, and all those things are actually required for you to show that there are wages. Wages is like the old school way of doing things. Every entity or every stakeholder, like banks, insurance companies, even the government, if they don't see wages, they automatically assume that this business doesn't have employees, even though the director or the owners work within the business. We saw this as a very big problem when there was COVID that happened, and then the government was trying to give grants out. But because it was a trust, and the trust distributed profits rather than paying wages, it caused a massive problem where a lot of trusts didn't actually get the grants that they were supposed to get because they couldn't prove that they actually had employees within the family. So that's why we recommend that because our society is still a bit old school, that wages is actually important. We need to show some sort of wages for the stakeholders, and stakeholders being the ATO, the government, banks, when you're trying to go for loans. One big one is insurance. If you're trying to apply for insurance and you hurt yourself at work, because you're an owner of the company and you're working within the company, you can also get workers' compensation. I've actually hurt myself doing accounting once. I was lifting files and I cut my fingers, and surprisingly, it cut my tendons. Like I couldn't move my fingers at all. So I had to go surgery, had to go do all this stuff, was out of work for like a month or two. And it was covered by workers' comp. Luckily, I did it during the time when I was working for someone. But if I was my sole practitioner and I was working for myself, if I didn't have wages, it's hard to prove what was my remuneration. What were they going to pay me in terms of like insurance claims because I didn't have any wages shown. So that's why I recommend putting yourself on wages for all the stakeholders out there that you need to prove yourself when you provide pay slips. You can actually do that. If you don't have wages and you just work off like dividends and loans from the company, it creates a problem where people sometimes actually don't think that you're actually making any money at all, and they won't be able to pay you insurance payouts or like grants and stuff like that. So it's always a good idea to have wages. So that's one reason why we always recommend having a mixture. A lot of people don't like wages, and the reason why they don't like wages is because you have to deal with superannuation, you have to deal with pay slips, you have to have an accounting software. And also on top of that, you need to pay your taxes regularly. So when it comes to wages, you pay your taxes every month to quarter. Yeah. So every month to 3 months, you lodge something called like a business activity statement. And that's where your taxes get paid. And then dividends, you don't actually need to deal with the taxes for your dividends until when you lodge your tax return. So that's tax return lodgement, and that's once a year. So you really you can delay your taxes until the next following year, because when you lodge your tax return, it's 15th of May 2026 for the 30th of June 2025. So you can take the money out as a dividend, but don't have to worry about the taxes until next year, which is a great vehicle for you to be able to avoid paying taxes for the first year, and then you pay it next year. However, you got to be careful, because sometimes if you take wages and you take dividends at the same time, then sometimes people don't realize that if you get the timing wrong, you could be paying taxes in your wages, and you can also be paying taxes on dividends as well, and you get double taxed. And that's what I mean by being very careful of the way you draw money out. The last thing, which a lot of people like, is drawing money out using a loan. It's tax-free because it's not considered income. So in your personal name, you don't pay any tax on it. However, if you've borrowed money from the company, you have to pay it back. So there's a liquidity issue. The problem is because it's a loan, you have to pay that money back. And if you've borrowed the money for more than 12 months or before, and you haven't paid it back before 30th of June, then it becomes, they call it a Division 7A loan. And you need to do it properly. You need to, I call it commercialize the loan, charge interest, have minimum repayments, make sure that you pay it back within a set amount of period, which usually it's 7 years. And if you don't do that properly and don't have a loan agreement in place, then it doesn't become a loan anymore. The ATO treats it as a dividend. And that's where you get double tax, because you've taken this money out, you're going to get still taxed in the company for that money. And also you get taxed the money again in your personal name. So you got to be very careful when drawing money out. All right, so tax treatment, just to explain again, is tax gets paid monthly to quarterly. In wages, dividends get taxed once a year during lodgement of return. And then tax loan, it's NA, no tax. So a lot of people love using loans, but you got to be very careful of loans, is because when you take that money out of the company, you have to pay it back. However, if you've actually sent money into the company first, when you first started the business, then you don't have to pay it back, because when you take that money out, you're repaying, the company is repaying for the money that you invested into the company. So say that when you started the company, you invested $20,000 into the company, and the company, set up the new company, paid for costs for accounting, paid for your wages, all those expenses that it's paid for, it would have borrowed that money from you. So therefore, you can actually repay your $20,000 you've taken out. So therefore, it's actually a very good way to minimize the tax as well. So you just got to look at the options for you on how to do it. What are the disadvantages of each of these three? Disadvantages of these three is, so wages, you have to pay taxes on a regular basis. That's very annoying for people. And one big negative is superannuation. So super, a lot of people hate it because they have to pay 11.5% of superannuation for each dollar that you take out for wages. And then on top of that, you also need to pay the taxes. And that could be like anywhere between 15 to 47%. So you could lose quite a lot of money by taking that money out. So like, let's just say that you took out $200,000. You want to take out $200,000. You could lose this plus this. Okay, this is a rough estimate. You could lose $117,000 and you're only left over with this amount of money. That's why a lot of people hate wages. Like they don't want to take the wages out. However, you got to understand that if you're taking a whole bunch of money out of the company, the superannuation isn't actually a tax. It's actually money that you're using to put into your superannuation so you can save. That money you can utilize later on down the track. We have strategies of being able to take that money out. We have strategies of being able to invest that money. And then you can actually make a good amount of income from that. And it's taxed very low. And when it comes to taxes, obviously, if you're paying 47%, you don't pay 47% directly of the 200K. We actually try to minimize your tax by doing a hybrid where we don't make you pay too much taxes. So if you look at your tax rates as an individual, our goal is to stay within the 45K to 135K. So this is the tax rates for individuals. And the tax rates for individuals, they bracketed. So the first $18,000 you make, it's tax-free. Then the next $18,000 to 45K, it gets taxed at 16%. And then 45 to 135, it gets taxed at 30%. And then so on all the way to 190. And then it gets taxed at 45. But you have to add the extra 2% for each rate because they make you pay Medicare levy as well. So what we prefer to do is we want to stay around this threshold or this bracket. And the reason being is because this is taxed at 30%. And what is the tax rate for a company? The tax rate for a company is 30% or 25%. So 30%, which is here, or if you're considered a small business and a base rate entity, you can be taxed at 25%. And like I said before, it's based on the income. Is the income earned through passive income? If it's passive income, then you tax at 30%. If it's business income, then most likely it will be 25%. So another way to say it is if you're a small business, you're taxed at 25. Yeah. So we like to stay at 25 in the company, and we like to stay at around 30% or 32% for the individual. Okay, why is the individual rate higher than the company? Like, why don't we keep it lower? Why don't we do 16 cents? And then that's 18% overall and pay yourself 45K. The reason why I say you can't pay yourself 45K is when you pay yourself 45K, let me just do a calculator right now for you guys. How much are you actually like paying yourself after paying the taxes? So once you pay yourself taxes of 4,800, you're left with $40,000. Like, you live in Sydney or you live in Australia, there's no way you can live off 40K these days. Like, rent alone will cover is pretty much $40,000 these days for a family. So there's no way we can actually pay you 45K to live off. We actually need to take physical money out and spend it personally for your expenses and bills. So that's why we always move up a level to 135. Some people may stay at 45, and the reason why they stay at 45 is because they've got savings or they've got capital that has from like a capital gain that they sold previously, and they've already paid the taxes on it in previous years. So they can stay at 45 because they can use money that they've paid tax on already. So there are options where that happens. Or some people may not make that much of a profit, and so therefore they'll just pay themselves 45K and they'll live off like, their savings or a loan from the company. Sorry, not a loan from a company, a loan from the bank, like their mortgage or the offset account where there's cash in there. And they're happy to pay the lowest tax bracket they can, which is 16% to 18%. Yeah. So some people do that. So you just got to look at your situation, what works for you. Wouldn't the total rate be closer to 30% in that case of the 200K? Yes. So one thing I want to mention is that if someone is on 200,000, yes, their tax bracket is this one here. They're not paying 47% on every dollar on 200K. Remember, what I said was the first bracket is 18,000, and that is nil. So for that $200,000 you make, the first $18,000 doesn't get taxed. Then the next 18 to 45 gets taxed at 16 cents. So it goes all the way up to the top, and then only $10,000 or well, 9,999 gets taxed at 47%. Okay, 47 being 45 plus the Medicare of 2%, 47%. So not your full amount of 200 is getting taxed at 47%. So that was a good question that was raised. That means that your total tax on a 200K income is actually 63,000. So when you do the a quick calculator, the actual effective tax rate is 63,138 divided by 200,000. It's actually 32%. So it's 30-ish percent. And it's actually quite good. So some people actually want to boost their income up to 135 to 190 because they're happy to pay a bit extra than the small business tax rate of 25% and withdraw that money out. But just got to be careful because there's super as well that you need to account for. When I wrote down the 47%, it's not exactly 47%. I just did a really quick maths on it, and it's, I'm wrong when it comes to the actual progressive tax rate that we have in Australia. So it is progressive, and the actual effective tax rate is about 30%. Still higher than the 25% that we're talking about. So some people, like for my situation, I actually pay myself about up to 190K now. The market salary is 190K, but I do it for tax reasons as well. So I try to keep myself around 190K because that's $58,000. So if I do 58 divided by 190, it's about 30%. And I'm happy to stay around that 30% because I need that money to survive, to pay for my mortgage, pay for my expenses, looking at maybe possibly starting a family. I need that extra cash and I want to save that up. So as a result, I'm paying myself about that amount. However, in your situation, it's very different.
Is there any, is the ATO, check on you when you adjust your salary, like, every single year? So let's say I'll bump up my salary up because I'm an owner of a company and also I pay for myself as a seller at the wages. If I bump up my salary, for example, 180K this year,
Yep.
and the next year I'll drop down like, 45K, right? Because I know I got some other money from, the cash saving, something like that.
Is it risky with the ATO? Is that what you're saying? Like, would the ATO like question it and then say, oh, you've done something dodgy and then like, make you pay taxes on it? So that's a very good question. There are a few ways to answer this. One is personal services income, PSI. If you the ATO does have a few rules to try to prevent you from doing what we're trying to do, which is like, how would you say, splitting your income or moving your income away from your personal name. So if you're trying to move income from your personal name, then it's possible only if you meet the personal services business rules. All right. So that's the 80-20 rule that we talk about. That's that rule where if you're providing a service personally, if you don't know what PSI is, please search it up. You can find PSI David Mack on YouTube and you'll see all these videos that I do. I've done like 3 videos about it. The first thing first is you got to meet those rules. Once you meet those rules and you're considered a personal services business, then technically you're able to leave profits in the company. There's nothing wrong with paying taxes in the company for the income that you earn. So for example, you might have a business in car washes or a cafe. Personal services income doesn't affect that because you're not really selling your time or your effort or your labor. You've got this legitimate business and you've got employees that you're running a business on. Or you might have a consulting business like similar to mine where you have 20 plus employees that do the work. Therefore, the profits that you make isn't really part of your personal exertion. It's not your labor. So therefore, PSI rules that also don't apply as long as you meet the PSI rules. Then you can actually leave the profits in the company. The ATO does not have a rule where it says that you have to pay yourself market salary. Okay, just want to point that out. You don't need to pay yourself market salary. The only reason why you need to pay yourself is those PSI rules. What they will do though, is they can audit you if they feel like you're buying all these assets and your taxable income is very low. There are a lot of people on the news that get caught out on this, right? There was a news article about a guy that was on social welfare, and he had a Lamborghini and he had a nice bike and he was living in an apartment, very expensive in Parramatta. So the ATO and the government and the cops, they also look at that and they would audit you for those reasons because they have access to data matching softwares. And those data matching softwares is just like, other government organizations as well as like other like big organizations like the banks that provide information to them. And if they find that there's something suspicious about your income and your spending habits, they'll audit you because they think that you're hiding your income. However, if your income is good and you've made income previously and now your income's low, you can still prove that you've actually paid the taxes. The whole point is they're trying to find if you're dodging your taxes, but if you've done everything right, whereas you've paid the taxes, but it's in the company, then it's fine. One last thing to answer that question as well is they can get you on Division 7A. So remember how I told you that you can draw money out of the company? So you can reduce your wages to $45,000, which is what we talked about here, right? And then you can just pay yourself $40,000, $5K to taxes, and great. But if you go have a very big spending habit and you buy Lamborghinis and you buy houses and all these assets get put in your personal name, then the ATO then goes, hold on a sec. Mr. Smith has been getting taxed that only his taxable income is at 45K, but he's buying this house for $1 million. He's buying a Lamborghini in his name. Okay, something looks weird. And then they audit you personally. And then they go, we see these income or these deposits coming from, this company. And this company is called ABC Pty Limited. So then they realize that you're a director of and shareholder of ABC. So they look at ABC. So once they look at ABC, they'll find out that ABC, this trading company, has been lending money to this individual. So then they will ask the question, is there a loan in place? Or maybe it's dividends. Has the income been treated properly? Or has these loans been commercialized properly? Is there a Division 7A loan? And that's where it can cause a significant issue. That's where you can get hit, where they go, all right, well, yeah, you've been showing 45K. That's not market salary, but we see all these deposits and you haven't actually treated them as a proper loan. So therefore we're going to treat it as a dividend and you pay tax on it. So that's how they get you. Those are the three main issues that you can have while drawing money out of the company or reducing your income, because you still need to survive. That's the problem. But if you can prove that you surviving on money that's already been taxed, then you should be fine. Does that answer your question?
Yeah, they did.
Yep, perfect, great. I won't go into much more explaining about what wages are, dividends and loans, but because you can actually watch it on my channel, and you can watch the videos. I want to actually go through key examples that a lot of business owners face. So let's start with the first one. The first one is the business just started. Business owner invested $50,000 into a business as a loan. All right. They could invest as a capital. So same thing. If you're buying shares into a company and you buy the shares for $50,000, kind of like investing it into the company as well. I generally advise clients when it's a small business and you're setting up a company, don't buy shares or don't issue shares for $50,000. Always lend the money to a company instead. So because on the balance sheet, then that means that the company owes you $50,000. But if you were to buy the shares for $50,000, that means the company doesn't owe you anything. You're a shareholder. It's $50,000. If the business goes bust, then you can't ask for that $50,000 back. If the business goes bust and you were borrowed $50,000, the company owes you $50,000, you can technically ask for that money back. Okay? It's business 101. Shareholders are the last to get anything from a business that fails. So that's why I generally tell our clients, don't buy shares or don't issue shares at 50,000 or whatever investment that you're putting in. Lend it to the company. You don't technically need a loan agreement unless you want to, but yeah, you could have a loan agreement in place between you and the company where you've lent money to the company when it first started. Okay, that's a key point. So the next thing is the business owner has stopped working. So stop working as in stop PAYG, doesn't work for anyone anymore, wants to go full into this business. But the year-to-date income they earned from the previous job was about $50,000. A business makes profit of $150K and expected to make profit up to June 2025 of $150K. Okay, so now we've got 150K profit for the business. We've got this personal individual going to be earning $50,000, and we've got a loan that's in credit. So meaning that the company owes the individual $50,000. What should we do? So what are these three things that we should look at to be able to minimize tax, or what are the best options? So I've actually got this group structure template that I have for our clients that we always create. And then I usually use this to explain to clients what we should do. So as I said, there was $150,000 profit. The tax will be about 25%. So this is where we do tax planning. In April, May, and June, we'll sit down with the client, or the client will call us and we'll go, all right, let's do some tax planning. Let's look at the profits that we think you're going to be making, which is 150K. Let's look at the income that you've already generated personally, which is $50,000. That's from your previous wages when you stop working in, say, like November or October in 2024. And now you've got $50,000 paid to date. In that $50,000, there's tax already withheld. So let's just assume the tax was $15,000. The employer previously paid them $50K, but they withheld 15 grand in taxes. Cool. So now we're stuck in this situation where there's a profit of 150K. Should we pay the individual more money as a form of a wage, dividend, or loan? Dividends, there are a difference between unfranked and franked dividend. Franked means that there's tax that's been paid on that 150K. Remember how I mentioned there was $150,000 profit? If you take that 150K out and put it into your name, the tax needs to be paid on that before the tax credit follows through to the individual. This is the part where a lot of people say you can get double tax. If you take that 150K out and then give it to this person here, what would happen is it's going to be, they call it unfranked dividend, and it will get added here. So I know that says fully franked, but just ignore the fully franked. It's not fully franked. It's going to be 150K added to here, and then your tax goes to 30%, and you're paying $60,000 on that 200K. But where did that 150K come from? It came from the company. So the problem with dividends is that in Australia, when you take up a dividend, it's not a tax deduction. You don't get a tax deduction where you can take off 150K here. You have to actually pay the taxes of 25%, which is here. And then you're left over with the net profit of that minus this, which is 112,000. Then you pay that 112,000 here. So pretend that this is the next year, so 2026 or 2026. I can take this, I take the profit of the company and leave it in the company, pay the tax of 25%. Then the next year, I'm allowed to take a dividend of 112,000. And that dividend is they call it fully franked, meaning that there's a credit that follows that dividend. And that credit is that 37,500 that you've paid in 2025. It's a bit confusing. It's just that the company needs to pay the taxes before you can actually get that credit. It's very similar to wages. When you are an employee of a company, if I say that I'm going to pay you $50,000, I don't physically pay you 50. I pay you 45K and I withhold that 5 grand and I give it to the government. Then you can get that 5K back when you do your tax return. It's a similar situation with a company. So with a company, the only difference is that they don't actually know how much you're going to declare until the end of the financial year. So they have to wait for the end of the financial year to work out what the profit is, because during the year, you could be up $100,000, and then on the last day on 30 June, you decide to spend $200,000, then you're in negative 50K or 100K. So that's why they have to wait till when the tax return gets lodged. When the tax return gets lodged, then the tax gets paid of 37K. That gets added to, then you can distribute the dividend, and the dividend of 112,000 will be fully franked. What does that do to your personal name? So this is what happens. So in 2026, so this is the next financial year, you can actually distribute that profit. This will go to zero because you've already paid the tax on it. Say you had made no profit in 2026, and you can actually pay yourself from the existing money that you're sitting in the bank account, and then your income will be 162. But there's one thing that's missing, which is the fully franked dividend. So remember previously there was 37,500 that was paid. That 37,500 gets added to your taxable income when you take a dividend. And that credit grosses up your dividend. So your income now becomes 200K and your tax is 60, but you've got a credit of franking credit of 37,500. See that 37K sitting there? So you have withholding tax, wages of 15K, franking credit of 37. So your total income that you earned was 200K. You're supposed to pay taxes of 60 grand, but the ATO adds these up, adds up the Medicare, and then reduces your total tax that you need to pay, and you only need to pay 12 grand. So that's how you don't get double tax. But if you do the timing wrong and you pay the dividend now when it's not, the tax hasn't been paid in the company, you get taxed in the company. Then bring back to the next thing. You get taxed in the company of 37K, and you also get taxed of 60 grand. So that ends up being 90 grand overall, 98, as opposed to 45K.
I have a question, Davey. This is kind of the scenario, right? So let's say we have, in your business, right? So we have the money there, which is those money I already paid tax for last year, right?
Yes.
For
Yep.
example, this year in the half year now, so I lost income from business. So it means there are no income to the business, and I still paying, employee wages until the end of the year, right?
Yep.
So I use the money I already paid the tax and pay employee. So is that I pay double tax because tax has already paid for the company. Now I use that money to pay for my employee, which is double tax.
So did you make any profit in the new year in the company?
Let's say for example, only 3 months I make very less.
Yeah, say
for
you made
example,
zero.
4 months, right? 3 month profit, and the last 9 months I didn't make any profits,
Yep.
right? So but I use the money from last year, which is the money I already paid tax.
Yep.
But it's a fully frankly, dividend.
Yeah.
which
Yeah.
means
So that situation, I would change the way you do things. So for the first 3 months, maybe pay yourself a wage. Say it's $50,000 for first 3 months, and then you know how the company is making zero like money. Say it didn't make any money after paying the 50K. There's no profit in the company, but you have leftover profit, retained earnings, which is the profit from previous years of $500,000. So therefore, you've got 500K in the bank. The tax has been paid for. So what you could do then is take a dividend. So you take a fully franked dividend, and you then have a chat with your accountant. Hopefully that's me. It is me. But like go $80,000, and then you go, all right, well, I want to stay under the tax bracket of 25. I want to be effective tax bracket of 25%. Then you pay 80K to yourself as a dividend. Then you don't get double tax because the company doesn't get taxed anymore because it didn't earn any profit. And the tax credit that you paid, the 25%, gets followed through here. So you'll get 80,000 divided by 75 times. Divided by 75 times by 25. I think it was. That's how you work out the tax on that. The franking credit. So then your total taxable income is this, but you also get that as a franking credit. So the way it happens is that 80 grand that you receive from the company, you take it as a dividend, that gets added to your income, but the tax credit that you paid already follows through and it gets added to your tax return as well. So you don't get double tax. You get that credit with your
how do we know that? Let's say in the first 3 months we still got, and then we lost the business with all the customer client, and we don't have any income. How can they make that decision? When? You know what I mean? Because we still like, okay, in the end of the year we maybe have more customer, but we don't know, right? We don't know what's happening in the business, right?
Yep. So what you do is you stop your wages. That's the first thing, and then you pay yourself. But then you pay yourself as a loan, and then you pay yourself from like, let's just say that it stops in September or October. This is a really great question. This is something that happens actually in real life. It happens to loads of clients. What happens is they lost their income. They decide, all right, I don't want to put too much pressure on the business because it will cause cash flow issues. I'll stop my wages. Instead I'll do is I'll borrow money from the company. And then at the end of the financial year, hopefully my income comes back up. I can then back pay it into as wages. So say that you end up taking like $10,000 or $5,000 per month. Yeah. So that times 9 months in the financial year, because it's the first 3 months you actually get paid, you took 45K out. So right now we're treating it as a loan. Okay. The first things first is if you can turn it around, then what we do is we convert that 45K into wages, and then we just gross it back up. We do that in June or in April, sometime in there. And we decide that, okay, well, now that the company has made the profits back and got a new customer or got more customers, then it can afford to pay the super and taxes for it. If it can't, then we go, all right, this is the option. We either treat it as a dividend because there's retained profits in previous years and there's a tax credit for it, or if you have the cash in your personal bank account, in an offset account or something, pay it back to the company and then it's gone. There is no loan that you've taken. The last option is you can't pay it back because you can't afford it, and also the business hasn't been doing well. Then you just have to create a Division 7A loan, which is the worst case scenario. It's not even that bad, but yeah, worst case scenario is that we don't treat that 45K as income because we don't want to pay tax on it. What we do then is just have a loan agreement in place that you'll pay this back, and you can extend the paying of this 45K for 7 years. But obviously there's interest charges that the company has to charge the individual, the employee or the director. And also, you have to make minimum payments. The great thing about the minimum payments is, okay, say the interest is, say, all up $10,000. I made this up, yeah. And then overall, you have to pay 55K back. The great thing about this is you can actually pay that within 7 years as dividends. So what you can do then, because you have unfranked dividends, is instead of paying this 55K back over 7 years, you can take a dividend and say that the company owes you money because of this dividend, and then offset this dividend against the repayments. Remember how I told you guys that you have to make a minimum payment every year because of this Division 7A rule? This loan has to have minimum repayments. You can't just pay it at the end of the 7 years. You have to pay it every year. So you have to pay like at least like $8,000 every single year to cover for that 55K until it's paid off. All right. But what we could do is treat that $8,000 as a dividend, and the company owes you that $8,000. So if the company owes you $8,000 and you owe the company $8,000 in repayments, it offsets each other, and then that's good. But as a result of that $8,000, you will have to pay taxes on that $8,000, and that $8,000 gets added to $8,000 here. Okay. And then you pay taxes on this amount here. Make sense?
Yeah.
Okay, guys, this is very, very confusing. For some people that have just started this, don't feel like overwhelmed. This is something that we work with you on, and we usually sometimes make the decision without even telling you because it's just too confusing. We look at your whole situation. We look at your company profits. We look at your individual name, how much money you made, and we also ask you like some questions. Okay, so what do we consider when we decide wages, dividends, and loans? We consider these 7 factors. What is your market wage, and what should you really actually pay yourself? And do you want to pay super? So that's one first question that we ask. The second question that we ask is, did the company actually make a profit? Did you and the company, the business overall, actually make a profit? The third one is investments and potential income. So what is your other income that you earned? If you had any personally, or you want to make other income, like you want to take that money out and then you want to invest it somewhere, or what are your current investments and what are you potentially wanting to invest in? They're the questions we ask. Liquidity is, if you draw the money out, can you actually physically pay it back? So some people will go, I don't want to pay any taxes, Davey. No taxes. I hate taxes. And okay, great. You don't need to pay taxes. You can just pay that 25% in the company. That's the lowest you'll get. But then you can draw that money out, but you got to make sure you pay it back within a period of time. So that's why I say liquidity is a main thing. Don't go spending that money on a Lamborghini that you can't convert back into cash and give back to the company. If you do that, there's going to be a problem. Timing of cash flow. So like I said, with the timing is, the main issue of timing is that the fact that you can't actually, you need the taxes to be paid before you can actually draw that money out so as a dividend. So timing is really important. So it just depends on what you're planning to do. If you're taking that money out personally and you're using it for mortgages or buying a property, I always try to get you to pay wages to yourself first, because I want you to pay the taxes for it. A lot of people, what they do is they take $200,000 out of the company and they don't pay the taxes, they don't pay the super, and then they spend that $200,000 on a deposit on a house. And that causes significant issues because they can't get that money back out. Therefore, they have timing cash flow issues, because when they launch their tax return a year later, they've got taxes to pay in their personal name or taxes to pay in the company, that 25%. They'll have 25% they'll have to pay in the company if they had like a $300,000 profit. And then they've also got like 50K, say, in wages, and they took a dividend. Say they took dividend now of like 150K. That's where they get hit. They've got taxes, 75,000 they had to pay here.
and fully franked dividend that gets with a credit that follows through, but they're still got a leftover amount of taxes to pay, which is these amounts here at 98 grand. So they took 150K out, and they also paid themselves for 50 grand. So the 200 grand, 250 all up, 50 grand as taxes, franking credit, and they borrowed some money out of the company. Say they borrowed another extra 100K out. So they had like a total of like $200,000 to $300,000 to put down as a deposit. If they spend all that money and take that out, they don't have much leftover money to pay for taxes. So that's why I always try to go, all right, well, instead of taking a dividend, maybe it's better just to bump up the wages of 200,000, pay the taxes on it, so that you have leftover money of, say, that minus this 140K. So you spend a bit less, so you don't overcommit. So they are things that you need to do. And it's always good to speak to your accountant before you make a decision on buying a property or investing in something. So the timing of cash flow is really important. Personal spending and taxes. So I always ask the client, how much money do you actually need to use to survive? Because there's no point putting you on $45,000, getting taxed at 16 cents in a dollar or not 18 cents in a dollar, but you can't live off $40,000. It's just no point, especially when your mortgage or your rent and your expenses are going to be like 60 to 80 grand a year. So that's one reason. And the last thing is loans. Are you trying to go for a loan? Do you have loans within the company? Yeah, and that's where it affects you. So these are the things to consider. And I'm just going to quickly go through quite a few examples just to explain to you guys how to think, but always confirm with an accountant before you make a decision with the for your company in terms of wages and dividends. Okay, next thing is example 2. All right, this business, they've invested in it. This is 5 years ago. Now it's been running for quite some time. Now it's very profitable. All right, they are estimated to make $600,000. And there's a husband and wife working in the business. They're making 600. They haven't decided on wages yet. Then they come up to the accountant. They go, all right, my goal is to take the money out and buy my home. Like, I've worked really hard for the last 5 years. I've also, started a career in whatever it is, say it's accounting. And my goal is to buy a house and then renovate it. So I need a lot of money. All right. So because they're going to take a lot of money out of the company, the options are either take a wage, dividend, or loan. All right. So it's the $600,000 they expected to make during the year. Say that in the previous years, they weren't really that profitable. They were just paying themselves wages just to survive, but there's not really much profit left over. Then we had to consider what are their goals. One of their goals was personal spending. They want to buy a home. Another goal is to get a loan. And another goal is they don't mind taking wages, but they want to kind of minimize the super as much as minimize the super, because if they have to take like 11% to 12% out of that 600K and pay it to super, they won't be able to take that money and use that for the deposit. So I asked them, do you want to put money into super? They said, no, not really. I just want to buy a home so we can start a family. So that option, I would tell them, you either pay yourself $45,000 each just for the sake of having that for insurance purposes. Yeah, so now like you've got this, just in case something happens, you can claim workers' comp to yourself, for yourself. You can show to the banks you have some sort of wages. You don't need to do this because this would attract 0.115% in super. You don't need to do this. You can choose to go, all right, zero wages completely. And then what you could do is you don't even pay your dividends for, say this financial year is 2025. You might even decide, you know what? I'm going to just leave all the profits in the company. I want to pay the taxes first. So you would decide, I'm not even going to take, I can take that money out. You wouldn't be able to take a portion of it out. You just need to pay the taxes for it. And I'll work out that figure for you. So I actually think the dividend and loan scenario is the best move because you don't want to pay super on it and you want to use that money personally, but you have to pay the tax. The first thing you need to do is think about the tax. So let's bring you over to this scenario here and just delete this. The company's made 600 grand. So what I'll do in 2025, if the client just wants to minimize their taxes completely, I'll make the client pay 25% in taxes. In franking, like in 25% here, I'll possibly maybe ask the client if they want to put themselves on some sort of wages, And the reason why I'll do that, if I do that, the great thing is that this will get reduced, but I get to access their lower tax bracket. The lower tax bracket is this beautiful looking thing here. So if I put them on $45,000 for this year, they're getting taxed at close to $5,000, right? What is that effective tax rate? The effective tax rate is like 11%. So you see how it's $5,000 including Medicare levy? It's 11%. That's amazing. That's a lot lower than this.
Let me curious,
Yeah.
why don't you put them into 18%, which is without tax?
Oh, 18,000 you mean, yeah?
Yeah.
I
In
wanted
this
to kind of,
situation, right? They say they're gonna minimize the tax.
Yeah.
18,000 without tax. All
Yeah.
right, 45 we still pay tax.
it's a good question. I'm just trying to figure out the best way to answer it. In 2025, you could be zero taxed or you could be at 16 cents in a dollar, right? But if you do zero, what's going to happen is you're going to push this 510K, the leftover profits, into the next year. Assume I do that. Assume I go 18,000 here and then 18,000 here. What happens to the profit for next year? It's 564,000 as opposed to 537. What happens in 2026 is I got to split this money between these tax brackets and the 25% tax bracket in the company. I'm using 2 years to be able to minimize my tax. I want to actually maximize the least amount of tax. Yes, I'm making you pay more in the first year, 16 cents in a dollar. But I prefer that over making you pay 25% next year, because this leftover profit, what's going to happen to this leftover profit in 2026? These two will go away. You're going to be left with 564. So 564. That's your retained profit. If I were to take that dividend, assume I take the full amount. All right. Oh, sorry, you can't take the full amount. That there gets taxed first. So you're actually left with 423 as a retained profit. That's sitting in your bank account because you pay taxes. You already just assume that you paid the 141. Assume next year you make no profit whatsoever. Okay, just to make it easier to calculate. That 423, you want to take it out now. In 1st of July, after the financial year, you decide, I want to take that dividend out. So you take the full dividend out. 423. So 423 divided by 2. You're now at the 30% tax bracket. No, even more. You're at the 47%. So now for the extra $10,000, $20,000 that you've left here, it's getting taxed the highest tax bracket. That's why you actually want to maximize the lowest tax bracket in 2025. Because if I did that, these taxes would be less. So instead of it being 423, it'll probably be 380. And then you split 380 between the two people, and you're probably going to be at a lower tax bracket in the next financial year. So that's why I usually argue to clients that, hey, you got to pay yourself something. Put yourself on 45. The only downfall of putting yourself on 45 is the superannuation that you have to pay. Let's try this example. Example 4. I think this one's a very important one that we need to know. Let's just say you go into business for 5 years, and then now you realize, oh, wow, this year is going to be crap. I'm going to be making a loss of $50,000. And this actually happens. It happens to everyone. Your business should not always be going up. Sometimes it goes down because you made decisions, took a risk, and it didn't go well, or the bloody government keeps bloody increasing interest rates or won't reduce interest rates. And as a result, people aren't spending as much. So what's happened now is there's a loss, $50,000. In previous years, there was a loss. And then during the year, you were paying yourself $100,000 through the company. You got a loan. That's how the company can afford it. And each director, the husband and wife, are getting $100K. So during the year, I would actually sit with the client and go, hey, I don't think you should be paying yourself $100K. And then they would ask why. And I would say, because you're paying $200K in wages, but you're making a loss of $50,000. So this is what's happening in your situation. So I'll draw it back up here. Say it's a loss, 50 grand. And it's a wage of that. And then there's a wage of this. Yeah. And this actually happens. And the reason why they can do this is because they either invested money into the company themselves. So they either took money out of their offset account previously and then put it into it, or refinance and put money into the company. Or they decided to get outside investment or loans, like through a business loan. And that's how they can pay themselves $100K. So what I would essentially do instead is reduce these $100K and I'll possibly look at how many losses carry forwarded they had. Let's just say that they had losses of, let's say, another $50,000. Yeah, and say there's no retained profits. What I would actually do in this situation is actually ask them, maybe we should reduce your wages. Don't put it up to 100K anymore. Put it up to only 45,000. So therefore, your total income is total family income is that $90,000, and then this would then get increased. So initially, they were going to be making a loss of negative 50 grand, but because you're reducing your wages. Okay, I've ignored super, but just assume that you've ignored it. Now your profit goes up to 40 grand. It was initially negative 50, but because we reduced the wages of 55K each, it's now added 110K back into the profit of the company. And by doing that, what's happened now, the overall tax scenario is 20 grand that they're going to pay, right? But we forgot about something here, which is losses carried forward. If you made losses in previous years, you can actually claim it. So therefore, you can actually drop your taxes, reduce this profit down to 0, and then pay 5 grand each. Ignore these because there's no withholding tax. We haven't taken up the withholding tax yet, but they only just need to pay 10 grand for total tax for the whole year. So this is better than doing this situation where it's 100 grand. If they pay themselves individually 100 grand because they need to live off it, they need to pay $22,000 each. And that's a lot of money. They can't afford it. So what I've done essentially is said, okay, drop your wages, use your losses carried forward from previous years, claim that against your current profit, even though you dropped your wages, make the company not pay any taxes, and then drop yourself into a lowest tax bracket possible. So that's something that you need to do and play around with. You don't have to, and this is back to your question, can I reduce my income? Yes, you can, because as a business, you can decide to not take wages and you can decide to take wages. It's up to you, as long as you're doing the right thing. If you go buying Lamborghinis, as long as you can prove that you made that money previously and you pay taxes on it, it's completely fine. In this case here, though, they've taken 45K each, and then minus the tax, they've only actually really technically made taken 80 grand. Remember how the deal was that they were supposed to needing to pay themselves at least 100 grand gross. So therefore, they short technically 110K. I haven't taken in consideration super, but taxes. So assume that are taking in consideration, they really actually need to live off these two, 160. So they say, David, it's all great and all, but I can't live off 80 grand. I need at least 160 grand for the whole family. Repayments on a loan, all that stuff like that. And then I say to them, that's totally fine. We can do that. It just depends on your loan. Like what we could do is we can look at your loan situation, because for your company to go into a loss in previous years and losses this year, losses in previous years, most likely there would have been you lending money to the company. So we'll look at the situation of the loans, see if you've actually put money into the company. If you do, then let's just treat the money that you need, the extra 80 grand, or if we can reduce that to 50, that'll be great. So you can say that 50 grand is a loan instead. So therefore you can take the total amount of 130K out minus the taxes of 10K, and then the 50 grand loan. And that loan will offset the money that you invested into a company for it to generate a loss. For a company to make a loss, you would have had to come up with that money from somewhere. It's either from a loan from a bank or a loan from you. So you can actually draw that money out of the company. Yeah. You can pay that money to yourself, repay your loan. So you don't actually need to get taxed on that 50 grand if you can treat it as a loan. So that's the way to play with the numbers to minimize the tax. If you're not going in a good situation for this year because there's a downturn in the business. It's things that we do for our clients and things that we want to get them to think about so they don't pay themselves 100K and then like get taxed. Because what happens is if you pay yourself 100K a year, this happens so much. It's so like disheartening when I see it, is that when clients get themselves 100 grand, the company pays for this tax. It's 45 grand. They can't afford it because there's no profit in the company. Remember how I said there was a negative 50 grand? What happens is they can't afford it. So therefore it's just it's just sitting there in the ATO tax liabilities, and it just keeps accruing. Interest gets charged. Failure to lodge, failure to pay penalties get charged on top, and then it just keeps accruing and it gets worse and worse. What we say to the client is maybe the first thing we should do is just reduce your income and treat it as a loan for the time being. We'll deal with the repayment of the loan later on down the track. We've got 7 years to deal with it, or year by year, make sure we take a repayment of a dividend to repay the minimum repayment. That's one way of delaying or just trying to survive as long as possible so you can turn the business around. You also do that sometimes just for the sake of like, you want to just save as much as you can for taxes. So they are the options. I also have a last one. They made $600,000 and they already have a family home. And the next goal is from that 600K, they want to invest with it. My thought is don't take a high wage, just take like 100 to 130K wage or 180, depending on how much you can afford. To live off, like how much you need to live off. No need to take a dividend. If you're going to invest, maybe you should set up a bucket company. This is the time where we talk about bucket companies to our clients. If you take up a bucket company, and if you lend the money from a company to a company, there's no taxes there. So you can lend, say you made the 600K profit, pay the taxes on 600K. So if you go 600,000 and then do that times 0.75, you're left over 450. Then you can leave the $250,000 in the company to pay for the tax, and then take the 450 and lend it to a bucket company. If you loan the money to a bucket company, you can use that 450 to invest. Is there any taxes on there? No, because the company and the trading company have a very similar tax rate, 25 to 30%, and the tax is being paid for already. It's that leftover money that we left in the company, which is, 150K. I said 200. The 150K that gets taxed already gets taken out of the profits, but you've got 450 that you can bring in here. A lot of people, a lot of accountants, I don't know why they do this, but they say, take that profits, pay the taxes, pay a dividend to yourself, and then you end up getting a higher tax bracket, 47%, and you end up losing more out of it, and you might get taxed like 250K as opposed to 150, and then they left with 350 to invest in their personal name. And I think that's a very bad way to invest because tax rate is 147% in your personal name. And also you only start with 350 rather than 450. So yeah, just options for you guys to use. Don't need to always take a wage, which is a lot of what a lot of accountants do, or even a dividend. You can always take a loan and lend it to another company. Yeah, cool. All right, guys. That's the main thing in terms of like how it all works. I figured like using spreadsheets to show you guys what we do in the background. We do a lot of this stuff before we even come to the meeting with you or before we even send you the documents. We do all this planning with the managers and myself and the team when we do your taxes. So sometimes you'll see that your wages change and sometimes we'll pay a dividend now and we'll explain. So the main point is to show you how this all works, and so you can ask the right questions. All right, guys, if there's anything else or any other questions, feel free to send me an email if you feel uncomfortable asking the question here. But yeah, if you need any help, just reach out to us. Cool, thank you.